You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend Russell Clark back again. Russell Clark, formerly the founder of Russell Clark Investments, and right now writes on russellgclark.substack.com.
That's Russell-Clark.
Russell-Clark.substack.com. Russell, thank you so much for being here. It is awesome to have you.
Hey, my pleasure. Absolutely. Actually, sorry, Stan, you were right. It was russell-g.clark.substack.com or russell-clark.com. Either of those will work.
Got it. Yeah. And Russell, the last time we spoke was at the end of January. And so, a lot has changed since the end of January. You've seen the introduction of the Federal Reserve starting to tighten financial conditions. And then before that, we've seen the Russia-Ukraine conflict start, and it's had broad effects on global commodity markets. I guess let's start there. So, when you saw Russia invading Ukraine, what was your first thought? And in terms of investment implications, we have definitely seen fertilizer prices and commodity prices, generally speaking, rise, especially in the immediate aftermath. But are there any risks or are there any opportunities that have not been taken advantage of when it comes to this geopolitical event?
Yeah, I think, the first reaction I had was, this is going to be, it's going to be very negative it's going to be very positive for a lot of commodities, and particularly in the fertilizer space. So, but also I was thinking this would create even more food inflation, which, because when you take Ukrainian exports of like sunflower oil and wheat, that has a big chunk of the export market that is not going to be readily replaced. And that's what we've seen is across the board, food prices have continued to accelerate higher. And the problem, of course, with the Russian-Ukrainian war is that it takes the food inflation analysis, which was which I've been bullish on for a long time, was a very simple analysis of supply and demand out of China, and now morph that into a much more difficult question of, is this conflict in Ukraine going to continue on forever? What does this mean for food exports? And it's made it much more complicated. Where we are at today just seems to imply that it's going to, that conflict is going to continue for a while. And so supply of grain and other food commodities, I think, are going to be tight for the foreseeable future.
Got it. And the other thing that we're starting to see is China increase their demand for. We've seen the lockdown, which is also important. But other than that, we've seen as China start to go hogs, and so when it comes to implications for markets, how are you thinking through that, and how are you thinking through the Chinese lockdown as well?
Yeah, so one of the sort of reasons I stepped back from money management for a while anyway was that I felt like there was a lot of changes going on globally, and I thought it seemed to me like I was missing something, but they were all connected. Somehow everything that was happening was connected, and I just needed to sit back and sort of work it out. I knew it was different to the world that we'd been in before. And so, there is, I think, a thread that joins what's happening in China, what's happening in Russia, Ukraine, what's happening in the States and Japan, and it all sort of, I think, is now coming together. And what I would say is that when we look at the US or the UK, what I think you're starting to see is that the political consensus that was very pro-capital, pro-free trade, is now broken apart. And what we're now starting to see is that is getting more and more reflected into financial assets. And it wasn't for a while, but now it is. And as we move away from free trade, or what I sort of say is away from pro-capital policies to pro-labor policies, inflation will be higher, and it will remain higher for the foreseeable future. And so the biggest sort of implication of that is that bonds still look like a short to me from here. I would say, you could get a potential rally on a positioning, or, if suddenly there was a breakthrough in the Russia-Ukraine, or China has a big sort of slowdown that crushes demand. But the political winds have moved to pushing up, wages relative to capital. And like the best way I can explain it is in sort of very sort of concrete terms, so people can get their heads around it. If you look at what happened to the minimum wage in the US from the end of World War II through to 1980, so that's a sort of 35-year block, it went from 35 cents an hour to $3.50, $3.75. Okay, so it rose 10 times over 30 to 40 years. Where we are today, so from 1980 to 2020, it went from 325 to 750. So you had a 10 times increase for the first 40 years, and it's only doubled in the next 40 years. And my guess is we're going to go back to what we saw from 1935 to 1980, where the minimum wage goes from $7.50, whatever it is now, to somewhere like $75 an hour, or $100 an hour. Okay. And the thing is that you don't want to do that. If you're focusing on improving the conditions of workers, which I think is an electoral political objective now, what that means is you don't want to be devaluing your currency, right, to achieve that. So you actually run tighter and tighter monetary policy. And so what I think is happening, and we're at the beginning of, is that the conditions that we've grown up in financial markets of unlimited liquidity all the time, right, to promote growth, we're actually going to get growth through people having more money to spend, but financial conditions will get tighter and tighter and tighter. And so what you should see is like very elevated ratios, like house price to earnings ratios, those sort of things will start coming down, mainly with house prices doing nothing, even as wages go up.
Mm-hmm.
Borrowing will become more and more difficult.
But from 1935 to 1980, the two broad events that we saw were World War II, and then after that, that also includes the period of the 1970s where we saw some amount of stagflation, and so when it comes to that sort of dynamic, are you expecting something similar to unfold over the say next 35 or so years?
Yeah, I would. I mean, what I would say is you got to remember the 50s and 60s were also a golden era for growth.
Right.
So you could get some sort of combination of those two. But what I would say is if you just look at how everywhere in the world is trading, it's beginning to move to that type of environment, and a lot of so one of the things that I'm writing at the moment, which will be up on my blog later today, hopefully, is that, one of the things that's like you don't think about because it's always been like that. But one of the things you notice if you ever go to Japan, have you been to Japan? Or?
I have not, no.
Okay. So one of the big surprising things when you go into Japan, like the 90s, and if you go to the States now, in Japan, there are 0 cars from the US on the roads in Japan. There may be a few Teslas now, but you never used to see a Ford, GM, Rise or whatever. But you go to the States, everyone's got a Nissan or a Honda or a Toyota.
Yeah.
And everyone, right? And you sort of, and you just went, okay. And you used to hear US politicians complain about it, but they never did anything about it. And the question is why? Why were they allowing a foreign company to come in and beat up these US icons. And the way I think about it is that the thing is that the US car makers were real bastions of unionized labor, right? And there was this consensus that unions had to be broken. And so the Japanese automakers and then the Koreans as well were like, and then some European ones as well, were this sort of spear tip, which was being encouraged by politicians to break the power of organized labor to make wages sort of stagnate and fall. And that was a political winner because consumers were happy to drive, frankly, what were better cars normally. And, it also tamed inflation. What I'm thinking now is we're in a reversal of that. One of the things I was sort of thinking about is if I was Donald Trump looking at re-election or, looking at, taking back the presidency, one of the strategy I would think is a political winner is running very socially conservative policies to attract, what would be naturally Republican voters to the Republicans, but then also pushing a sort of pro-US business, pro-US automakers, anti-foreign policies to attract the sort of swing states up in the Northeast, Pennsylvania's, Illinois is a tricky one, but that would be, I think, a politically winning strategy, and it's been a winning strategy in the UK. So Boris has managed to turn, a lot of sort of labor strongholds up in the Northeast, which is all the industrial unionized areas, to become conservative voters on exactly that type of strategy. And so when you think through the political ramifications of that, it implies higher bond yields. It implies stronger wage growth. It implies that the central bank activism, what we've seen over the last 5 to 10 years, is dead or dying. And it's potentially extremely negative for countries that are reliant on exports for growth. And so it could be very, very bad news for Japan, very, very bad news for Germany potentially, because they'll need a new model. Yeah. And that's sort of what you're seeing, actually. Yen has been very, very weak, surprisingly weak. And I think it's reflecting this new world, perhaps, that we're moving to.
Yeah, I see. Yeah, and so the other thing that that's important. So when you talk about exports, do you think China is going to be? Do you think China is also going to be suffering from the dynamic you described, where you talked about how the demand for exports could just generally drop because you're seeing, for example, Boris Johnson wanting UK work, or at least telling UK workers that he's going to keep jobs in the UK and not export them overseas. So do you think China is also going to be suffering from that? And one more interesting thing is that, so a few days back you wrote an article on your Substack titled "Demographics is Not Destiny," and obviously contradicting the common adage which goes demographics are destiny and demographics are everything. So when you talk about that, do you think Chinese demographics actually matter at the end?
Okay, so a lot of questions there.
Way too many.
That's okay. I think I remember them all, but just remind me if I skip any of them. So the first thing is China is already much further down this route of controlling corporates, raising taxation, tightening liquidity, keeping their currency strong. So China could have chosen to devalue back in 2016 if it wanted to, and keep running with this export-led growth model. But instead, they've kept their currency strong, and they've taken over much stronger control of the financial system and do targeted lending, and they're promoting domestic consumption aggressively and trying to push wages up. And so China is actually a lead, in many ways, a lead economy on this. And they're so far, while it's easy to look at the current problems with COVID and other things, if you look at Chinese GDP, it's continued to grow, and they've continued to have a strong currency, and I think this creates political problems for the states, because if China doesn't devalue and it keeps growing, it's going to continue. It's going to become the biggest market, the biggest economy in the world, and all of the things that implies politically. So it becomes a big problem. So what, so China is, I think, the lead economy in many ways. And so that I don't think is going to be a problem for them. Where it's going to be a problem is places like I said, Japan and Germany, who have not, who have, always focused on export-led growth, particularly to the States. And so, there's some issues there. Now, when I talked about if you take that line of thinking, which is a little bit speculative, but I think it looks quite convincing to me, you then start thinking about demographics, all right, which is when I started writing about demographics. And so, if you look at, like I mentioned earlier, minimum wage in the 30s, went up from 1939 through to 1980. Minimum wage went up 10 times, right? And you had huge population growth. And then the minimum wage in the US has done virtually nothing for the last 40 years. And population, if you exclude immigration, population of, fertility rates have declined, all right? Now, it's a brutal reality. If you can't feed yourself, why would you have children, right? If the average worker is struggling to feed themselves, struggling to afford payments or whatever, it's just struggling, and wages are poor, you would naturally expect birth rates to decline. It's just a very simple observation, right? The old saying is, if you breed them, you have to feed them. So and so it makes total sense. So what I've been, when I'm saying demographics is not destiny, what I'm trying to say is demographics reflects politics, right? So if you have an environment where you're screwing the worker down because you need to compete against other workers internationally, you're screwing down unions, you're giving more and more wealth to fewer and fewer people, then you would expect populations to growth to decline, right? Okay, that is one thing. So that thing I think is changing. So that was the one thing that made me think, okay, demographics here is changing. The follow-up note that I'm writing at the moment, and I'm starting which is absolutely fascinating, is that I think there's that political shift has caused demographics to weaken, but there was also I think a big cultural shift. So actually getting birth rates, good demographic data pre-World War II is actually a struggle. And the best ones I've found so far are the UK. And so what I was looking at the UK is that in 1939, the average age that a woman first became a mother, right, was 26. And then by 1969, it had dropped down to 23. And then from then, it's now gone up to about 30. So that leaves me with, a couple of questions, right, which I'm working on. First of all, what exactly happened in the post-World War period, right, that suddenly made women go, you know what, I want to have a baby at 23 or younger, because this is the average. Or another way of putting it is, what caused teenage pregnancies to spike in the 50s, 60s, and 70s? And all I can think is that if governments did have explicit policies to promote fertility or promote births, so there's places like Australia had the populate or perish type policies, which but they also were pushing up wages. And so the economist in me thinks that if the economy is favoring labor, right, wages, then that is going to elicit a supply response, right? So if labor is paying, then people are going to be encouraged to have more kids. That's there's a sort of bit of a, I think there's something to that. And if you start, paying really poor wages, then you're not going to have it. So one of the graphs I have, which I really like, and intuitively makes sense, is what I've tried to do is taking US minimum wage, federal minimum wage. I've tried to calculate how many Big Macs you've been able to buy over time. All right. So how many Big Macs using, if you're working at minimum wage for a month, how many Big Macs does that buy you? Right. And back in the 60s and 70s, it bought you about 500 Big Macs in a month. Right. Now it pays, now as of today, at minimum wage, it buys you 200.
Wow.
Right. And there should be, I mean, it sounds like when you go, what are you talking about? Why would you do minimum wage and Big Macs? And I was like, well, actually, the guys making the Big Macs tend to be on minimum wage, as a rule.
Sure, yeah.
That is true. And they also tend to be consumers of Big Macs.
That is also true.
It is also true. So there should be a very tight relationship between what you're paying, what the minimum wage is and what the price of the Big Mac is, right? And basically what's happened is Big Mac price goes up, 5 to 10% most years, and minimum wage has been really, really lagging. And so I look at that, and that's another reason why I think if policies turn towards promoting domestic population growth, which again, feeds back into a movement away from free trade and to promoting domestic and national interest more than international interests, you should start seeing wages starting to rise, and the share of GDP going to corporates and other things should decline massively. And so where my thinking is, markets actually just represent, stock markets and asset markets represent political policies that are put in place. And they only, and what's been interesting is from 1980 on to about 2016, we had exactly the same policies being implemented, regardless of who got elected. Okay. And with Trump, Brexit, populism in Europe, changes in China, the world has now moved to a different set of policies, and markets are reflecting that. Makes investing very, very tricky because the policy is for rich people not to get richer, right? And it's for average workers to get richer. So we're in a new world, I think. Hopefully that answers all your questions. Oh, sorry, one other thing about demography. So there's that political argument. The other thing I found really interesting is that I've been able to get good data from Australia and Sweden on so when women give birth by year. Okay, so what I've been able to do is build out like cohort graphs. So what I do is I look at women born in, so when did women born in, let's take the year I was born, 1974. I want to chart how many births have been given per year by women born in 1974, and then compare it to, let's say, women born in 1990 or women born in 1965, right? Just to see, how is that changing? And it was what you see basically is that back in the women born in like the 50s, who started giving birth in the 70s, had a very skewed graph that was to the left. So it went up very quickly and then sort of dropped off. So they tended to have a lot of their children young, right? And then, as you would expect, that shift has been, the plateau came down a bit and shifted to the right, but actually then extends out longer over to the right. Okay, so when women's, what you saw was a lot of rules relaxed to make it easier for women to work in the 60s and 70s in particular. So a lot of women went into the workforce. Again, this was to increase the supply of labor, drive the cost of labor down. And then what you saw was that, women delayed having children till later in life. Now, what I'm saying, and what my new note will be when I finished it, is that it was a one-time shift, because when I can see in the data now is that women are not delaying it any further. So we had a one-time shift from peak births being at 24 to now peak births at 32, but it's not moving to the right anymore. And in fact, the curve is getting steeper out to the right because more women are having children in their 40s and even 50s. And so the emphasis of that note is saying there was a one-time shift which created the illusion of aging and declining fertility. But that shift in the data I can see in Australia and Sweden at least is over, right? So when I combine those two separate ideas, what I think is we're potentially at the precipice of a baby boom.
Wow. That is fascinating. And so and also, moving on from talking about China and demographics, when it comes to the US and what the Fed is doing at the moment, how are you thinking through that? And one, do you think inflation will actually remain transitory? And because even the Fed has thrown that out of their book. So do you think the Fed will actually be successful in bringing down inflation, considering that a large part of it is caused by, one, supply chain issues, and two, supply shocks that are arising from the Russia-Ukraine crisis?
So, if you follow the logic of like the capital labor stuff I've been talking about earlier, I think inflation will not be transitory. I think inflation now is systemic, and it reflects political changes that have been occurring for the last 6 years or so. And so, the system, the previous system, economic and political system, was set up to encourage deflation. And this new system is set up to encourage inflation. And so the Fed, I think the Fed doesn't actually change anything. It just follows the real world and politics. And so I think inflation is going to stay strong and it's going to stay high. And the Fed is going to struggle, will be under extreme pressure to try and control it. And so I see interest rates continuing to climb, bond yields continuing to climb, and the Fed being, broadly speaking, powerless to do anything about it, absent jacking rates up to 10-15% to create a recession. I just don't, the way policy is set up now, I just don't see what they can do. And if you, I just don't see how they can stop it. My general advice to people is just, you may see a rally in bonds, but I don't think we're going back to the bond bull market. I'd say the bond bull market coincides with political changes, and now the bond bear market is going to follow those political shifts. Where I could be wrong, which is an important thing to say, is if I'm wrong on the politics and suddenly, we go back to how politics was 10 years ago or 15 years. I don't think that's happening, but I could be wrong.
Yeah, no, that makes sense. And when it comes to currencies and thinking through what central banks are doing, globally speaking, so one thing that we can see is that to an extent the hiking cycle is coordinated. So to an extent, most central banks are hiking at the moment. And so how are you thinking through what this implies for FX? Because in a way, FX is where it gets interesting, because it's sort of not because it's not actually deal with relatives. So it's sort of like which central bank is doing more than the other. So how are you thinking through what's going on in FX, especially in cable and yen?
So I mean, with cable, I think this is the issue that I'm sort of grappling with, is that the old macro analysis would make you bullish on the euro and yen, given their trade surpluses, given the actually relatively cheap exchange rates, and given that the US looks very expensive on most measures, and that capital flows into the States have been extreme. And also, when you see a declining equity market in the States, it has historically not been good for the dollar, normally, generally speaking. On the flip side of that, however, is that, if the US is, still has tariffs on China, if policies continue to move to being pro-labor, it does imply that, exports from places like Germany and Japan to the US are going to come under pressure. And so you could see, for example, that if you thought, tariffs in the States were going to continue to rise, then you would expect the currencies of exporting nations to devalue to offset that. And so, I can now make a reasonably good argument for yen weakness. And I've always been a fan of the yen because it's just so cheap there. and they haven't had price increases for a long time. But they've got so much excess productive capacity. If they can't export it to the States or elsewhere anymore, then they're in deep trouble, and they're going to need to do a political and economic realignment of some sort to generate growth again. And I think there may be some signs of that, but it's not happened yet.
Yeah, that makes sense.
Currencies, the other thing I would say about currencies is I think I would be surprised to see currencies move very much these days. Ruble is a good example of it. Ruble, got destroyed and then has rallied way back above where it was before. And I think that's the currency regime we're in, where we'll trend in one direction and then it'll quickly reverse, and we won't get the big movements that historically we've seen in currency markets.
And do you think, that is a broad change overall, that the old school macro is sort of dead, or the old school world of macro is sort of dead, and in a way we're in a new, this broadly speaking, regime when it comes to macro trading?
Yeah, I think the old school macro was, again, when I was saying, like, the politicians welcomed Japanese automakers into the States because they wanted to crush unionized workers. The big movements in exchange rates was really a symptom of that same free trade system, where currency volatility acted as like a brake on wages moving too far out of international norms for any country. So if one country was booming and wages were really strong, you would then get the currency pressure to quickly push those wages back to competitive levels, and which would be better for business, but very bad for workers. So the currency volatility and macro volatility was a symptomatic of a political system that was looking to create efficiency and keep wages pretty much low everywhere. So my view is we're moving to a different system, and China has been the lead on that. If China, back in 2015-16 was faced with a sort of uncompetitive exchange rate, current account deficit, lots of dollar debt, and they could have just devalued. Instead, they put on capital controls, they've kept the currency relatively strong, and they've taken more and more control of the economy and corporates, but they're still growing, and they're trying to reduce income inequality. And that's really the roadmap now. If I'm wrong, what I'd expect to see is our RMB to be very, very weak, and not just against the dollar, on the cross rates versus the euro and yen, which is not done so far.
Got it. And so the other thing that we've also seen driving yen and currencies in general has been commodities, and specifically oil. And so, what are your thoughts on US shale these days and the oil environment in general?
Yeah, normally what I look at is the EIA drilling productivity report, and the one for May just came out a couple of days ago, which I haven't had a look at. But what you have seen with the shale industry, which hasn't changed yet, is that previously they massively overbuilt, so they had huge inventory of wells. Now what they're doing is they're drilling, but they're not over drilling, so they're not building out an inventory of wells, they're just keeping it under control. So what I think represents is that, and something I thought was coming, is that if you look at the US shale industry from now compared to 10 years ago, 10 years ago you had a number of different producers everywhere. There's a real free-for-all, huge competition both for land and other things, and everyone was trying to grow as quickly as possible. What you've now seen through a number of mergers and bankruptcies is really like a big six of shale drillers who control most of the leases, and they are controlling growth to a much greater degree, which means that I think US shale production will continue to grow, but it's not going to put the downward pressure on prices that it did for the last 10 years. So shale looks good. It just, you're not going to see, I don't think shale is going to lead to lower prices anymore. That'd be my observation.
And how do you think, with their idea around that So broadly speaking, do you think we will see a similar overconstruction in oil, assuming that say oil goes a bit higher from here, say to 150, 200? So do you think we would see a similar cycle where companies start to throw money at oil again and see a similar overinvestment in the industry, or do you think that oil is just going to probably stay at a permanently high level?
I think it's going to stay high because the one of the big changes that we've seen. So, for example, U.S. puts tariffs on Chinese imports, so that where it never had tariffs before. So it matters where the product comes from now. You've seen the same in the oil market. U.S. can't buy Russian oil.
Russia.
Right? So the market has changed. So where the oil comes from is more important. And what that does is it creates a lot more political uncertainty. So if you were, for example, going to be a U.S. shale guy, if you wanted to really massively increase production, you need to be certain that you're not going to see Russian oil come back to the market, right? And that makes it tricky, right? And that's actually why I think inflation picks up, because the environment for investing, like long-term capex for business, is not really great anymore. You're not sure if you're going to end up with a stranded asset. You're not sure if you're going to be able to sell to whoever you want to sell. You're not sure, if you're going to be able to get the supplies that you need to run it.
Yeah.
If the Chinese. So what I expect to see is, like I said, I think inflation stays higher for longer because that is where the politics is pushing.
Okay, and let's move on to Europe. So we've gone from China to America, and now we're going to Europe. And in Europe specifically, how does the Eurozone actually reconcile with what's going on in Russia? So one thing that Russia has done is they've used the Trump card, which is their control of agriculture, of ags, as well as oil commodities, and
Yep.
they've used that as a Trump card in order to get an upper hand at roughly speaking at the negotiation table. And so how does Europe actually commoditize? So how would they actually go about reducing their dependence on Russia? Would they have to see a shift towards, say, uranium, for example, or do you think we're going to continue seeing dependence upon Russia? Because again, obviously, it's considering how hostile Russia has been and has proven itself to be, it is best if they don't depend on Russia. But how are you thinking through that?
So I think what you're seeing now is that the sort of, if you looked at the political situation that we've had for a long time, was the US was a dominant military power, and then for a while you had the Soviet Union as a competing power, but those were the two poles, and you hid underneath one of those.
Yeah.
That made sense. And Europe, Western Europe in particular, hid under the sort of US one. And that sort of worked for everyone. The US didn't really want competition. No one wanted a world war anymore. So they wanted some sort of organization, stable structure. And now we're moving to a more unstable structure. And I think that means that Europe really has to change, and it is changing. So Germany needs to spend more, and it is, on military and defense. They need to start thinking more strategically about where they get oil and gas from, how they do that, investing. And it also, I think, means that I think from a European perspective, it actually, the Russian invasion of Ukraine suddenly gives the EU meaning. So you can see the outlines of not only a economic union, but a proper political and military union. And so, one of the upshots, I think, of the Russian invasion of Ukraine is that Europe will become like a much more cohesive political unit, because it has to be, because and it also means for countries like Germany and France, they need to take a far more interest in the politics of like Eastern European countries like Poland and Hungary, which have, particularly in Hungary, have had sort of pro-Russian sentiments. They need to find a way to make So this is what I think is the real driver is politicians need to find a way that makes the system work for most people, not just a few, right? People need to feel that they're getting, paid enough to have children, paid enough to buy property, paid enough to be, a fully paid member of these societies, rather than having a system that seems to benefit just a few. And Europe, I think, is going to go the same way. And that's going to be both like the big Germany, which has benefited most from the EU, is going to have to, bring everyone along for the ride. It means they're going to have to sort out the problems in Italy and the problems in, other places. They can't just be left in status anymore. They have to be resolved. And so there's a lot of change that I think it's quite bullish for Europe. I'll be honest with you. Europe is like a sleeping giant. In my view, it has the education, has the resources, has all these things, but the political situation was very stagnant, and I think that's now changing. And so I think Europe is the sort of the slumbering giant that's about to wake.
Mm-hmm. And do you think that overall you sort of described the dynamic of how previously in the Cold War you had these two poles, right? So you had the U.S. and then you had the Soviet Union, and so Russia is sort of trying to retake that role of the Soviet Union. It's got some amount of competition from China, but at the end, when it comes to the dollar status as a reserve currency, so one thing that you did see was historically oil has always been traded in dollars, but I think a month or two back, the Saudis agreed to exchange oil with the Chinese for yuan, which was interesting to see. So do you think? And so and on the other hand, the other dynamic that's happening is that Switzerland is also starting to pick sides here, because historically it's always been neutral, and it has been known. It has been known for just being neutral. And so when it comes to So when it comes to thinking through that, do you think the dollar has any challenges to its status as the global reserve currency? And if so, where do we spot these emerging changes to this?
So the big issue is that, so Russian foreign reserves are suspended, so they couldn't use them, right? And the US has used its financial leverage for anyone who does dollar transactions is now sort of basically under the influence of US policymakers. Now, when you think of it, when you look at that, I mean, is that acceptable for most nations, to that the US can dictate who you trade with? Is that acceptable? It's totally unacceptable. But that's where the policy is. Now, they've used it with Russia because they invaded Ukraine. Fine, everyone accepts that. But you'd have to be thinking, well, when do they start doing that for China? When do they set the terms for who can and cannot trade with China, and on what terms they trade on? And so what I think it means is that it does ultimately create an incentive for countries to stop using the dollar, and a strong incentive. And it means that there'll be a strong incentive to look for a workaround for some sort of metric that you can use, or some sort of asset that you can use that is not under the control of US authorities. And so I can't help but feeling that, we potentially could be heading back to the use of a gold standard of some sort. Because the gold, it can be just used as it doesn't have to be transacted. It can be used as a collateral, and it's also untraceable, more or less, if you need to. And so, I could see that some sort of commodity-based currency, which people are talking about, could come in, because using the dollar in a free trading market made sense. It was easier. US had the military power and the control to do that. And, generally, you only wanted to trade with US allies anyway. But now, for a country like Japan or Europe that has equal exports to China as it does to the US, do they want to be in the middle of an argument between China and the US? Probably not. So they need a new financial system that allows them to compete. And again, it's logical. So something's going to give. What that is, I don't know. But something will have to change to make the system work for everybody, one way or another.
Yeah, and yeah, that's sort of what what's been the bulk of our discussion so far regarding policy. I wanted to go back a few years and touch on a different topic. And so a few years back, I think in 2018, you wrote about semiconductors and how semiconductors would have been a good choice. And it's a very well written, very well argued piece. And you sort of concluded that the combination of a possible collapsing demand from the cryptocurrency mining sector and the entry of Chinese competitors into a consolidated sector makes me suspect that the probability of semis going soft is quite high. No, but since then the semiconductor ETF has rallied a couple of 100%. So what really went wrong there, and how has that evolved?
So I mean, back in 2018, you have to remember that crypto, so Bitcoin fell from like 20,000 back to sort of like, I don't know, 3,000 at low. It was quite a low one. And what I had seen was there was a lot of building of semiconductor facilities in China. It was a little bit hard to get the data, but there was a lot of building. And you was, and so I looked at it and I thought, well, look, you've got a very cyclical sector. And if you looked at when semis had collapsed before, back in 2000, with when the sort of dot-com bubble had burst, and you saw the bottom drop out of it. Now, what I got wrong there was, even though the Chinese were building the facilities, the US then, you had this market that was far more consolidated and easier to control. So essentially for high-end semis, which is where most of the movement in market cap has come from, that has been a controlled market. So you haven't had the entry of the Chinese that I thought was going to come. So ASML has come under real pressure not to sell cutting-edge semiconductors to Chinese producers. And so the market, I got that wrong in that I thought the market was deconsolidating, that is, you gain new entrants, but actually the new entrants in China were cut off at the knees, like Huawei, but also all the other ones. And so that market didn't. And then, of course, we've seen that crypto in general came back stronger than ever. So that wasn't the top. This time is looking much more tricky for crypto, I think. Much more tricky because you're starting to get frauds emerging. And also the interest rate environment is changing a lot. So that note was wrong in that it was maybe 4 years too early.
Yeah.
And 4 years too early is wrong, but it is interesting. The other thing that, so I was very wrong on that one. It was I was right for a little while because it's long lost in the history of financials, but you did get like a profit warning out of TSMC, which drove the stock down, good 15-20%. But then
the trade war as well.
Yeah, and trade war, but then the market just took off the other way. And again, that's the other reason I sort of stepped back, is like, okay, the way I used to analyze things wasn't working very well. And also COVID was a good example. In the old days, COVID with the collapse in demand, you should have seen bond yields go to the roof, yen should have rallied, big bankruptcies and a weak stock market. Instead, we had this very different type of market. And so, what I'm saying is I'm sort of getting my head into where the world is, but the big problem is I don't think it's a world that suits old school macro hedge fund type management, which is what I think it's a slightly different world. And I'm just working out, how I should invest and where is the best business opportunities in that new world. And it may well, and that's where I'm at the moment.
Yeah, and B, touching on the topic of semiconductors for another minute. So when it comes to Russia, Ukraine, people have sort of remarked that, while the U.S. said all this stuff about China and has said all this stuff about Russia and they've not actually sent troops, for example, and they've completely changed their foreign policy. They've pulled out of the Middle East, they've pulled out of Afghanistan, and while those are less economically important, when you think about semiconductors, you think about Taiwan. And so, people have also started talking about how there is now a potential chance that China might actually invade Taiwan, and one obviously that has broad-reaching consequences for semiconductor markets. But how are you thinking through the probabilities of that event?
It's possible. It's definitely possible. What I think is the most likely outcome, in my view, is that countries are now thinking strategically about supply chains. What you've seen is Europe and the US is throwing money at building domestic fabs. So they don't want to be reliant on TSMC has 90% market share in the high-end semiconductors, and they make all of them in Taiwan because they try and keep the process secret, which is totally understandable. But I think everyone recognizes that that is not a long-term answer. A bit like relying on Russian gas for Europe. It was always an issue, and now it's actually being dealt with because it's no longer sustainable. So what I think is going to happen, to be brutally honest with you, and a little bit sad for the Taiwanese, is that the US, Europe, Japan, everyone will make sure that Taiwan stays independent until they've built high-end fabs in their own countries. And then they won't care anymore. So, why has the US left the Middle East, more or less, is because they don't buy Middle Eastern oil anymore. China does. And so they quite rightly sort of say, well, why should we be guaranteeing the stability in the Middle East and the oil supply in the Middle East when we're not buying it? We're actually doing China a favor, who's the biggest buyer of Middle Eastern oil. Let them defend it. And they've already built one base in Djibouti, I think. And I think they're looking to do some more bases in the region. And so it's just a pure economic calculation. And so I would say, until they've managed to get their own supply of semis. And so, if you ask about semis, that is the biggest number one bear argument, is that, as I said before, you want to short a market that's deconsolidating. So when all the shale producers turned up, shorting all the oil and gas companies worked great, right? And you want to buy a market that's consolidating. So, as they've consolidated the oil and gas names, they've done much better. And what I would say is, strategically, the semiconductor market looks like a market that's going to deconsolidate because everyone needs to have their own supply now. All right. So long term, I think semis is a dead market.
Yeah, no, that's fair. And so as you outlined, so the US will say that they will defend and they will help Taiwan until they get the fabs built in their own country. And then after that, nothing's gonna happen. And so the other thing that comes along with China is thinking through Hong Kong. You've had a lot of experience in the Asia Pacific region, and so how are you thinking through what's going on in Chinese property? And then when it comes to Hong Kong, what are the probabilities of a break in the peg?
So first of all, property, I think the Chinese, like I said, the Chinese are suffering from poor demographics even more than anywhere else. And if they want to focus on domestic growth, they're going to have to reverse that, right? And I think what they've done, which I think is quite sensible, is they've worked very hard to get the cost of education down. Now they're working very hard to get the cost of property down. Now they want to do all of these things without getting unemployment up. And so what they're doing is basically trying to get a soft landing on property, so the property goes sideways. So they're keeping interest rates strong to keep the currency strong, which keeps real wages high, and putting downward pressure on property. And there's talk that they may well nationalize a lot of the property developers. And the reason they would do that is that the property developers are saying, look, we're not going to make money on developing property, as it is, and that's counter to what the government needs. And so there's a reasonable chance that they may well, nationalize many of the property developers, much like they've, got control over the banks. So they're moving to an objective of improving welfare for the average Chinese. What does that mean for Hong Kong? Well, the thing about Hong Kong is, Hong Kong was a conduit to international finance, which is what China needed. But now what the US has shown with Russia is that international finance can be used as a weapon against your economy, right? So what is the point of Hong Kong? And the reality of Hong Kong is that when I first was living in Hong Kong back in sort of 98, right? Hong Kong was super advanced, super developed. They still did exports, still built stuff there. But now it's really just, it's not even like if you compare it to Shenzhen or Shanghai or Beijing, it's not even, it's like it hasn't developed a new business or company for a very long time. Tencent is our Shenzhen, likewise Alibaba, right? So the industries that Hong Kong has specialized and focused on are all old, and they basically have 5 families control all the wealth in Hong Kong, right? So Hong Kong, Hong Kong is sort of, it's like I was sort of saying, it's like it needs a new political and economic model. But when you have 5 families controlling all of the retail, all of the property, all of the main businesses, you're not going to get that change because they're anti-change. So I think the future for Hong Kong is that even now you still have a border between Shenzhen and Hong Kong. I think at some point that border goes away and you get a merger, so Hong Kong becomes submerged in a sort of bigger Shenzhen, Hong Kong, Macau, sort of region. And that is where the policy is going. And so then Hong Kong will just become, a suburb within a much larger region, I think.
Okay, Hong Kong is going to lose, its historical status as, the point of inflow for capital into China.
Yeah, I mean, you can see that. I mean, like Macau, used to be very, very different, but now it really is, it doesn't have that strong differences anymore. It's a Vegas of China, and I think that was always the destiny for Hong Kong. It's just that it's coming into view.
And so does the peg break?
I don't see why. What I think happens, what I think is going to happen sooner rather than later, is that the Hong Kong dollar gets repegged to the renminbi. Wow. And then they get rid of the US dollars in that system, because the US dollars are now can be used as a financial weapon, right? So they need to de-dollarize the Hong Kong economy. So yeah, yes, it'll depeg, but not in the what is commonly perceived as going to get destroyed, and the exchange rate goes to some unimaginable number. It gets repegged to the renminbi and eventually gets phased out.
Got it. And so just on the topic of pegging quickly, how are you thinking through what's going on with Tether and Luna, and just broadly speaking, the overall crypto market?
Sorry, what do I think is happening where?
So I believe so. Just a few days back, so Tether and so US Tether, the largest stable coin, and Luna, so they depeg in the crypto market. So how are you thinking through that, and how are you thinking through the crypto market in general?
Yes, so I mean, like I said, we've now seen liquidity getting withdrawn from markets, and so when you withdraw liquidity from markets, what you tend to get is anything that was a little bit Ponzi starts to blow up, and that creates a sort of an effect that just carries on. So what you saw, I think it was, you saw that one stable Luna blow up and go to zero, or close enough. And now that's putting worries through. So one of the things I look at is the market cap of Tether. And the market cap of Tether was a straight line, up from nothing to 80 billion. And now suddenly you're seeing money being withdrawn from that, which means that, it means that they have to be selling their commercial paper and bonds into the market to replace, to get people back their Tether. And so, that is going to create other problems elsewhere. And all it means is like the most, the really crazy stuff is getting destroyed, which has been happening for a while now. All the crazy stocks and other things are being destroyed as liquidity gets pulled. What I think people are missing, I don't think people get, is I think it's a secular change in how the world works. And I pretty much realized this. I knew this was roughly what was coming when the Chinese went out and destroyed all their tech companies, right? And you read all of it and saying, oh, China's a disaster, it's uninvestable, don't know what they're doing, why they're not protecting their national champions. And really it was the authorities saying, no, look, this model, which is creating income inequality, created raging house bubbles, creating huge speculative bubbles everywhere. This doesn't work for us anymore. It's unpopular. And because they're a dictatorship, strangely, they have to be more responsive to public opinion. Whereas in democracies, it's possible for corporates to influence opinions. It's possible for corporates to influence politicians. But in China, just saying, I'm Jack Ma from Alibaba, I'm going to go buy, he couldn't do Bezos and go buy the Washington Post and start pushing out his opinions and then, pay off a few, give some campaign donations to try and, say this, this is a policy that we need to. That's not allowed. Right? You do that, you're going to get put in jail in China. And so they've been able to respond to the change very quickly. And this is what I find really interesting is because, with the demographics, right, we were talking about before, everywhere in the world had a baby boom in the 50s, 60s. It didn't matter what political system you're under, right? And everywhere has had a baby bust since 1980s. And so what I'm trying to say is that there's a political wind that blows globally at the same time. And this is the modern world that we live in now, is that, a connected world that's been connected now for over 100 and something years just moves at the same place, same way at the same time. And I find it really, really interesting how that works. And we're living through a big change at the moment. And typically with big changes, there's a lot of losers and a lot of winners. And I'm just trying to align myself with the winning side, which is easier said than done, but that's what I'm trying to do.
Yep. So with that, thank you so much for being on the podcast. Before I let you go, could you tell the audience where they can find, we spoke about that at the start, but again, where they can find you and more of your work.
Yeah. The easiest place to find me is at www.russell, Clark, CLARK.com. That's basically where I publish all my stuff now. And, it's the easiest one to remember. And then if you just subscribe to that, you'll get free update sent to you. And the thing about most of my research is free. I do put some paid stuff up there because what I'm trying to do is generate like a community of people that want interesting analysis. But I don't want to be beholden to one single person. I want to have be able to do write about whatever I want without fear of, I might lose this big customer. I'd rather have lots of people giving me a little bit of money, and then I can write about whatever I want without any sort of prejudice or fear. Anyway, that's where you got to find me.
Yep. Awesome, Russell. Thank you so much for being on the show.
Thank you for having me.